Welcome to Friday's Financial Fitness. Today, I would like to start a 5-part series on investment principles. My intention is that over the course of the next 5 weeks, you will learn more information about investments and concepts and be able to share those with your kids and or grandkids to help them get a better idea about investing. For the first series, I would like to talk about risk. Often, when I meet with a new client, they will tell me they don't want to take a lot of risk. Risk, of course, means different things to different people. But in the investment world, there are lots and lots of different types of risks. Today, I'd like to go through 10 different types of risks that we look at. The first risk is what we call inflation risk. Inflation risk is the risk of goods and services going up in value. The second type of risk is credit risk. Credit risk is the risk of a bond or corporation not being able to meet its obligations due to its poor financial health. The third type of risk would be industry or specific company risk. This pertains to a particular industry or a company that may be negatively affected due to certain events that have occurred in the economy. Certainly in 2020, we saw industries that were affected by the coronavirus. The fourth type of risk is what most people refer to as market risk. And market risk, of course, is the risk of the market going down. The fifth type of risk is called interest rate risk. This is the last part of the 5-part series, and I will talk more specifically about that. But interest rate risks, in summary, is the risk of interest rates going up and bond values going down. The sixth type of risk is called reinvestment or call risk. Call risk is when you have a bond that is long-term and rates go down, and that bond is called out from you, and you have to reinvest that money at a lower rate. The seventh type of risk is liquidity risk. As the name implies, liquidity risk is when you are unable to convert your investments to cash in a timely fashion. The eighth type of risk is political risk or economic risk. This could be due to various political events or certain things that happen in the overall economy. The ninth type of risk is not that common, but it's called currency risk. Without going into a lot of detail, currency risk is simply the change in price from one currency relative to another currency. And the final and 10th type of risk is one that I have talked about extensively, and that is market timing risk. As I mentioned earlier in many videos, pulling money out of the market at the wrong time is considered market risk. Next week, in our second series, we will talk about risk versus return with different allocated portfolios.